Are you ready to take action to attain the lifestyle of your dreams?
It's a great way to make a lot of money fast.
Hey, what's going on, Clever Investors? Welcome back to the Clever Investors Show. I'm your lucky host, the OG Clever Investor, Big Spurbs. Today in the studio, we got two badass SEC attorneys that are going to help us make a whole bunch of money. And of course, my business partner, Brian, is back. We have Bethany and Mauricio Raoult in the studio.
Let's go.
All right, so let's kick this show off. So, look, I had Bethany and Mauricio in here because Bryant and I are coming up with a new fund. And we need to raise a lot of money. We're doing a lot of cool things in commercial real estate, and we don't want to fuck it up. We don't want to end up in prison. We don't want to piss any investors off. We don't want to set up our foundation the wrong way. So we want to do things exactly to the T, the right way, because when you're raising capital, you cannot screw it up. Like, there is no room for any mess ups. So maybe explain like what we're going to do with our new fund at Clever Capital Fund. Do we have a name for this particular fund yet? Just the $50 million fund?
The big ass
That's
fund.
amazing. No,
Big ass fund.
This one is definitely going to be a value add fund. It's going to be an equity fund. We're going to share in depreciation, and we're going to give fixed double digit returns. So this one's really awesome. Our first fund was just a simple credit fund, 10, 11, 12 for a 1, 2, 3 year commitment. This one's going to expand a little bit farther. It's going to go 12 month, 36 month, and 60 month commitment for 10, 12, or 14%. Add in, sprinkle a little depreciation, make it an equity fund, not a credit fund, debt fund. And then in addition to that, we're also going to do some education and break down the deals along the way through some webinars to show everybody how we buy banks, what we do to value add, and how we make millions of dollars with the fund's money.
So I'm already confused because that's different from what he just said about 20 minutes ago. So I want to dive into that.
Yeah, we got these two badasses on here, so me and Brian can hash out how to actually pull this thing together. How long have you guys been SEC attorneys?
I'm going to give my age away. 24 years. 24 years.
Yeah, I'm 25 because I'm one upping you. So yeah, 25 since 1999.
Which means he's older than I am.
Look at the hair, dude. Look at the hair.
Yeah, that means you're wise.
Look at that.
That means you're smart. And you guys have a company together called the Premier Law Group. You guys have been helping investors. Like, all the big dogs have been using you guys to set up their funds. I think you need, by the way, like, when I see your website, I think you need like all the big dogs' faces on your website, so that way you can show just what badasses you guys are.
It's coming. We haven't done a good job on the website, but yeah, we do represent a lot of the big people that I'm sure everybody knows. And so
drop some names.
The Brandon Turners of the world.
The Brandon Turners,
the Ryan Pinedas of the world.
Tarek El Moussa.
The Brian Appleses
Justin Wallers of the world.
Brian Appleses of the world.
Amen.
I like it. All right, cool. Well, we need a name for this fund. And the whole concept is we're buying a lot of cool stuff in commercial real estate, and we need a lot of capital to be able to do that. When you raise money, there's definitely a wrong way to do it, right? What are some of the big mistakes a lot of new investors make when they're trying to raise capital?
Probably the number one mistake new investors make is not even realizing that they're selling securities. Because that's what we are. We are securities attorney, SEC attorneys, right? And so people go out there and they start raising money, like, oh, I'm going to go raise 500 grand or $1 million or 200 grand. And they don't even think about these regulations or the securities. And it makes sense because they're buying real estate. Like, why in the world is the SEC, the Securities and Exchange Commission, even involved? But the reality is, anytime you're taking money from passive investors where the returns are generated by your efforts, meaning you're doing all the work, generating the return and giving it to the investors, that's by definition a security, which then opens up all the regulatory frameworks that we specialize in.
And that's where half your listeners are like, fuck. I've sold securities.
Well, 80% of the listeners, I don't know.
Yeah. Well, I mean, I've told this story in another podcast. When I first wanted to raise some money just to do some rehabs and stuff like that, I just started putting the word out to anybody who would listen, like, hey, I need some capital. And, one guy came in with 100 grand, somebody else came in with 50 grand, somebody else came in with 250 grand. And I just took all their money and I just threw it in my operating account because I needed money to go buy rehabs. And at the time I was buying a lot of properties at the foreclosure auctions. And I didn't think anything of it. I was just like, look, it's not a big deal. A couple friends, couple acquaintances that I met at networking events. It wasn't like I raised $100 million. It was a little bit of money. And it was all good until one of the people was going through a divorce and they said, I need my money back. And then I was like, I can't give your money back, dude. Like, we're cool. I already told you what it's not like I went and bought a Lamborghini. I bought a house. Like, here's the address. You know where your money's at. He was like, no, I need my money and I need it like right now. And I was like, that's not how this thing works. Right? Until I get a phone call from somebody like one of you two. Maybe you called me. I don't know. So the lady was a badass because she filleted me in like 3 seconds. She scared the you-know-what out of me. It was like, you're violating the securities law, blah, 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 blah. You're actually selling a security. You're not allowed to collude money or whatever she called it and pull money in your operating account. So here's what's going to happen. I'm going to audit all your shit. Then I'm going to contact every person that ever gave you money, and we're all going to come after you for this violation. I was like, let me get your money back, sir. Right away, boom, made magic happen, got the money back. And so that's the wrong way to do it, right? Yeah.
And in fact, that's what I generally recommend when I have, limited partners and say, hey, there's an issue with the deal. What should I do? And I'm like, well, if you tell them that if you don't get your money back, you're going to pick up the phone and call the regulators, that usually scares the sponsors into like, okay, well, let me get you your money back. But that's one. It's not uncommon. Your story is not uncommon. So the story of like, I don't know what I was doing when I started and I just raised a bunch of money, and it's not until later that you realize all the issues you've done. So you're not alone in that. So don't feel bad, Cody. Everybody does it. But it's definitely not the wrong way to do it.
Yeah, well,
that was like 15 years ago.
Yeah, that was a long time ago.
We just started.
We just started.
Let's get a very clear thing. I'm not doing that today.
Yeah, when we started 5 years ago, as me being your partner, this is our third fund now. So we've always made sure that we make sure every T is crossed and I is dotted. And I've, taken extreme ownership of traveling the country. I'm in capital raising masterminds groups and, worked with probably 4 different securities attorneys by now. And so I'm happy to finally land with you guys. And the fund for Clever Capital Fund is going to be amazing. It's going to be our largest fund. It's going to be $100 million fund. So
$100 million?
We're super excited.
I thought you said $50 million.
It's grown.
No, $100 million.
See, this is what happens when your partner is thinking way bigger than you. What are we going to do with $100 million, baby?
We're going to buy a lot of commercial real estate.
We better turn it into $100 million could buy what, $500 million worth of shit?
Yep.
All right, that's about.
You know how many banks you can buy with that?
Yeah. we gotta expand our at least my belief system. How am I going to raise $100 million?
Well, we're gonna give great returns without promising.
Well, you've already
say the word guarantee again, Brian.
There's some things that I learned. You cannot say the word guarantee. You can say the word fix. You can say the word pro forma. You can say, other things aligned with, just estimated, but projected. But you can't say guaranteed. We are going to be utilizing
even if it's like a marketing play, like if I'm real slick with my marketing words, can I somehow put the word guarantee in a sentence that alludes to the concept, but I'm not actually talking?
Yes. But
the only thing that we can guarantee is that we are not going to receive a dime until they get their preferred returns.
What a great student. Man, we just talked about this not too long ago, and here he is. You are a very coachable.
You learn lines faster than Mauricio does.
All right, so let's take a quick step back before we get into that, because I want to unpack our fund and talk about our stuff. Cool. So that way everybody can kind of listen in on us asking our SEC attorneys how we're going to pull this together. But let's take a step back. What are the different types of funds or options for an investor? If they roll up to you and they don't really know what's what yet, and they're like, okay, I think I want to raise some capital, are you going to educate them on the different types of funds? What are all the different types of funds for them?
Yeah, we are.
Yeah, I mean, usually there's a lot of options. So usually somebody comes to us and they already have an idea of what they want to do. But most people start with a project-specific investment. Like they're raising money to go buy that particular building. We have an address. We have a specific game plan for that deal. I'm going to raise the money. I'm going to, do a value add. I'm going to fix it up. I'm going to, upgrade everything. I'm going to raise the rents. I'm going to do that. We have a specific plan. And that's the easiest type to raise money for, because investors can see what you're doing. They can look at your assumptions. They can look at the pretty pictures. They know where it is. So that's how most people start. But at some point, after you get, like you guys have been doing this for a while, you've been doing this a long time, you get to the point where you've got you've got a great track record, you've got experience, you've got, people know that you're a good operator. Then people kind of go to the next level, which is, well, let me just put together a fund, what we call a blind pool fund, which is a little bit different because you don't actually know exactly what you're buying. You can't point to, hey, I'm buying this building, this building, this building.
Correct.
What you're telling them is, I'm going to go raise money and buy these types of buildings. And so you give them sort of an idea, a sort of a profile of the types of things you're going to buy, but you don't actually see it. And so people are investing really more in you guys. Like, I trust you guys and I'm going to give you my money. I know that you guys are good. And I know you're going to put the money in a good place, but I don't know where you're putting it until after the fact. And I don't get a say. I don't get to say, hey, I don't like that deal, I'm not going to put my money in. It's like, you put your money in first, trust that you guys are going to, execute the business plan, invest in the stuff the criteria that we gave them on the front end.
And we have real case studies in our pitch deck and our marketing. And so we've been there before. It's not our first time.
Yeah.
And so that's what's awesome. And what you were referring to earlier is a syndication, where it's a simple address and you're just using an SPV, special purpose vehicle fund, to raise money for that specific deal. And then when that deal's over, everybody is compensated and paid out. And
here's the challenge. It is much harder to raise money for a fund. Much harder. So that $50 million, it's much easier to raise $50 million if you tell them, I'm going to go buy this, 500 unit apartment building or this portfolio of 5 buildings, and investors can actually see what you're buying. When it's a blind fund, it's harder because, they can't challenge your assumptions. They can't say, well, I don't like that market. I don't like this address. I don't like that game plan. They're literally putting all that trust in you guys. And so,
I would agree to some capacity. However, I also have interviewed a lot of investors. I've done a lot of, the research, and diversification over a certain address, because with things correcting and capital calls and interest rates and being able to not know when you really can exit something versus a fund when it has an expiration of either 12 months or 36 months or 60 months. And we're only placing that money that we raised for those time periods in projects that allow us to have, a guaranteed exit. If we're going to do a 12-month, capital raise and we're going to inject that money into properties, those are only going to be our fix and flips that are 3 to 4 month exit strategies. If we're going to do a 36 month and we have that much capital that came in for the 3-year commitment at the 12%, we're going to put those into our new construction, new builds, value add, quick existing structure things where we don't have to go through entitlements or rezoning, things that won't get caught for more than 3 years.
Great.
And so we're very cautious, and diversifying between the commercial, the fix and flip, and our new construction allows less risk mitigation, for the investor versus a single property that, we all know. I mean, I've invested into private equity. I've invested into many multifamily deals that we've invested into with some of the best operators, and we're not getting our pref. We're getting capital called. They don't know what they think, that they're underwater in the property, all those things. And that's what we're trying to avoid with our equity fund and diversifying. So
I love funds, not just for the diversification, but also because of the strategy that's involved and the flexibility that it gives you to provide better value to your investors. But there's actually a really cool model that you can do that I think is the best of both worlds, which is you identify one asset and you raise with the investors and say, we found one and we're going to go buy more like this.
Yep.
So they get to look at your underwriting of the one. They get to look at the dirt. They get to see the address and all the things. And you give them that comfort. And then you go, you like that? Super. We're going to do more of that.
So we got to let the investors see up our skirts a little bit. We just got to show them the goods. But then, hey, we're going to get more of this. This is coming your way.
You like what you see?
That's the cool thing, is that we're actually going to do deal breakdown analysis at each deal when it closes and each deal when we purchase it, in our updates that we're going to provide monthly to our investment group. And so they get education along the way. So they get education, they're going to get some depreciation, and they're going to get those, pro forma double-digit interest returns.
So real quick, break down the different types of funds real fast. I just want the basics.
Well, when you say, so let's use vernacular, because when people say fund, sometimes they reference sort of, well, the fund is that's project specific syndication. I don't think of that as a fund, but that's option one. So option one is, like we said, I've identified a property, I do all my underwriting and all my due diligence on the property, and then I raise money for that particular property. Then you move into a blind fund, which is the reverse. You're raising the money first, then you're finding the property. It's literally the reverse. The first one, you buy the property, then you raise the money. With a fund, you invest the money, you raise the money first, then you invest in the property. And then the third type of fund is what we call sort of a fund of funds, which means you actually raise money into your fund, but instead of buying real estate or buying your own assets, you actually invest in other people's funds or other people's syndications. And that's what we call the fund of funds. So those are basically your three options. And then there's Bethany's actually, which is a good point. It's kind of like almost the best of both worlds, is that I call it a hybrid fund, but it's just a made up word. But a hybrid fund is exactly that. It's you've got a specific property or specific properties that you've already identified and you're in contract and you're looking to close. So you show the investors that. But then once you close on those, you continue to raise for other similar projects. And so it's almost like a little bit of a hybrid because it's like a syndication and also a blind fund. I call them a hybrid funds.
Okay. And what I was driving towards is we set up a fund. Can anybody put money in it?
That's who are your investors?
So we're utilizing a Reg D 506C.
Thank you, Brian, for showing up to the party here. That's what I'm talking about. What does that mean?
I am here. That means that we only are accepting accredited investors. They need to go to a website called verifyinvestor.com or get a letter from their CPA, $1 million net worth or $200,000 of income in the last 2 years or $300,000 if married.
You can do our job.
With the anticipation of making the same in the future. So
this is what I was
Look
trying
at
to pull
this.
out of you guys. So like,
This
what
is
is
so
a Reg D versus a Reg whatever versus a whatever.
let's break it down.
Let's talk about that because I think, Brian, you did a masterful job.
You
Just
really did.
for everybody listening, just to kind of pull it back so they get the context.
Mhm.
Once you understand that you are raising money from passive investment, once you're selling securities, which is what we're doing, there's three things you need to worry about. Number one, you either need to register that security with the SEC, or you need to find an exemption to registration, or it's illegal. Those are your three options. You register, find an exemption, it's legal. You never register because that's IPO. That's going public. Maybe eventually your fund gets big enough and eventually you want to go public, but you don't go public right away. You don't want to do anything illegal. That's why you hired us. So we're looking always for the exemptions because we don't want to register. So what's the exemption we're going to rely on? And the vast majority of syndicators will rely on, like you said, Brian, Reg D, Regulation D, which is one of the exemptions. And within D, there's a 506B option or a 506C. And you guys are picking 506C because 506C allows you to advertise the fund.
General solicitation.
You can generally solicit. You can accept people that you've never met before. You literally can meet them. You know, there's an event going outside this building. If you went out there, had a couple of drinks with people, and then, hey, you want to invest in my deal? You can do that with the 506C. But to your point, you're limited to accredited investors only. And you gave the perfect definition. It's anybody who has $200,000 in income the last 2 years with a reasonable expectation of earning that this year, or if you're married or have a spouse, $300,000, or $1 million in net worth, excluding your primary residence. Those are kind of your two options. With a C, you do have to verify, and you brought that up. You have to take what's called reasonable steps to verify that those investors are in fact accredited, so you can't take their word for it.
And you can verify by going to that Verify Investor website, or there's a bunch of them out there, or you can
parallel
go
markets.
get a letter from your accountant.
We're
or
not going to
CPA.
verify
The
them.
best way is a third party because you don't. Most CPAs, by the way, they're not gonna give you a letter that's suitable. They're not going to want to put themselves on the hook there. So the best thing you can do is the third party, which is Parallel Markets, Verify Investor, one of those
Correct.
websites. Super easy, not that expensive.
Which is awesome because, then we can work through the general solicitation and
I get screened from the mountaintops.
yeah, exactly. You can let
I'm
people.
surprised you don't have a Super Bowl ad coming out. Like you should literally get a Super Bowl
I
ad.
saw that the Super Bowl ads are the most expensive in history this year. It's gonna be crazy.
But they're also reaching a wide audience, so it's not necessarily they're a good
They
value
sure
still.
are.
I've been hearing they're a good value. Yes, they're expensive, but you're also the amount of eyeballs you have it. There's nothing that compares to it.
Yeah, we just heard a story of because we're in the flooring business now, and with our new company Floor Daddy, and we were hearing a story of how somebody else ran a Super Bowl ad, kind of a local version, but it was still very expensive, and put their ass out of business. They didn't make enough money.
Oh.
They didn't make enough money
Yeah.
to make their money back,
Wow.
and their business.
They should have hired
imploded.
you, man. They should have hired you on the marketing.
I know we could have made it sexier.
Mm-hmm.
Okay, so that's if we want to go after accredited investors. Now, what if we want to just, let's say we want to give the average
Mhm.
Joe or Jane out there a shot, right? Because like for our fund, what do we think our minimum investment's going to be?
50,000.
Okay, so if you're not accredited and you ain't got 50 G's, you can't even play the game. Okay. A lot of people can't do that. So if I wanted to work with somebody who said who's maybe brand new, working a normal job, has $10,000 saved up, they want to put $2,000, $3,000 towards an investment and go around and say, hey, I'm in the game.
Right.
I invested some money. I'm in real estate.
Yep. there's
That's a Reg CF.
there's
right?
a couple of
There's few options there.
there's a couple of exemptions. So I'll touch on a few, but one of them is this Rule 506B, which is sort of the original, the OG of the Rule 506B. So 506B does allow you to take a limited number of high net worth individual. We call them non-accredited investors. You
Up to 35, right?
Look
It's
at this guy.
35.
Look
and
at this
and
guy.
they've got to be sophisticated.
Brian, all this
Correct.
education, you flying all over the country, going to these events is really paying off.
Hey, I'm making sure that we're doing everything right and
like
our
it.
investors
I
are
think
protected.
he's just checking out the YouTube channel, man. He's just it's all on the YouTube channel, Cody.
It is.
So you can take up to 35 non-accredited investors. You can self-certify, so you can, as long as you have a reasonable belief, you don't have to go get a verification or anything like that. The challenge with that exemption is simply you cannot advertise. You cannot generally solicit. You generally have to have what's called a pre-existing relationship, a pre-existing substantive relationship with that person. So it's meant to really be your inner circle. These are my friends, my family, people I already know. That's what 506B is meant for. And to be honest with you, the vast majority of our clients use 506B because inevitably when you're raising, especially when you're just starting out and you got your friends and family, inevitably, Aunt Karen, Uncle Bob, they're non-accredited. So if you want to get them in, you do 506B.
And there's a lot of newbies that are out there starting funds. It's getting more and more popular because people don't want to pool. People don't want to, do it the wrong way. They're learning that you can, set up a fund, and it's actually pretty common. And you can set up a fund for, your small business. You can set up a fund for real estate. You can set up a fund for crypto. You can set up a fund for funds,
You can
funds.
syndicate pretty much
all
anything.
sorts of different things right now. And as long as you're following the rules, you're good. So talk about a little bit about converting a 506B to a 506C
I
in
love
the
you.
middle.
He's like, you can take our jobs at this point.
Have you ever thought about going to law school?
I
Getting
know.
away?
No, don't do it. We talked about this yesterday. We do not recommend that you become a lawyer.
Yes.
I don't know. We could use you, man.
I
Come on.
know. You're doing a good job.
Could Brian be your paralegal? We get him going.
Yeah.
Let's get our $100 million filled. And then
Yeah.
Once he's retired, he'll come work for you.
And he'll do it for free. So I love 506B to 506C for a couple of reasons. One is I like it when people are getting started because they want to get their friends and family in, that kind of thing, or people who want to let sort of the little guy come in, whatever. But also,
because I don't give a shit about my friends and family. I'm just trying to let the average listener in on our deals.
Yeah. Hey,
I'm trying to hook you up.
whatever it is. But there's a couple reasons why you might do that. One is to let the friends and family in. The other is to let the smaller investors in. And maybe you need to convert to a C for two reasons. One is maybe you can't fill the whole thing with your friends and family. I know I wouldn't have been able to fill a whole, especially not $100 million with people I know well enough to qualify for 506B. The other reason is to leverage an audience, which you have, right? So you want to leverage the audience. You want to be able to shout it from the rooftops, take out a Super Bowl ad, whatever. It gives you the best of both worlds. You get to get all those people in that you really want to have in there. And then you get to then advertise after that, if it's set up properly.
Yep, correct.
You get to eat. What's the saying? You get to
Have your cake and eat it too.
So I have a question. A lot of people are just like scared of funds. Should we be scared of funds? Because everybody's like, well, I want to get into real estate, but man, I don't have any money. Are funds super scary, or are they pretty much like, how can you bite-sized chunk break it down so that it's like,
funds are no scarier than anything else if you have the right people around you.
Yep. So
Like, what do you
your
mean
power
by
partners.
scary? Like, is it difficult to start your first fund?
Well, people are scared of going to jail, right? You start
you're talking about it from a syndicator standpoint, the person raising the money.
Yeah, I mean, a lot of the reason people don't raise money from other people is because they are scared that they're going to do it wrong,
Right.
or they're going to over leverage, or they're going to create some sort of Ponzi.
If I was new, I think my fear wouldn't be so much, am I going to do wrong? It's like, I try to do this fun thing and I try to raise $5 million and I end up raising 200 grand. And then I'm kind of like feeling like a failure, or like, what do I do now? I took 200 grand from my two friends, 100 grand each. And that's my whole fund. Like now what?
Yeah, and the challenge, especially for newbies, is that there's a cost. Obviously, as you guys know, there's a cost to do the compliance, and so you end up paying that out of pocket. And then, to your point, you only raise 200 grand and you don't do the fund. Well, you've already spent a ton of upfront costs to get the fund off the ground, and you didn't raise all the money.
What would happen in that scenario? Would they just like launch the money back and call it a day?
Yeah. But the upfront cost gets borne by the syndicator. I mean, you could do it with the investor, but that's not a typical thing. So in the documentation, we say, look, if for whatever reason the fund doesn't move forward, we just return all your money.
So what I learned along the way is work with sponsors, GPs that have a proven track record, leverage their track record. They'll bring you in as a fund to fund, right? Not a co-GP, not that kind of stuff. Like that was a big thing where there was like 30 different co-GPs on one thing. Like that's don't do that. Don't try to be a GP just because you raised money. You got to do more. And let's talk about that. What qualifies you as a GP versus an LP versus just somebody that raises money and earns a GP title. You can't just raise money to earn a GP title.
No, you cannot.
Let's elaborate.
You've definitely been paying attention. You're my favorite. I love this. You can't, to be a GP, you have to, or a co-sponsor or co-manager is the correct term is a co-manager. To earn that position, you actually have to have substantial duties. You're allowed to raise money for these. We call it the issuer exemption. You're allowed to raise money without being a licensed broker dealer because you're raising money to operate your business, which is a syndication business. If it's not your business, then you don't get to make money raising money for it, right? That's not. So if you don't have substantial duties, then you're not really an owner. It's not your business. So you don't get.
So you have to be
exemption.
active in the voting. You have to be active in the construction or the management.
In
things like that,
something
in some
other than
capacity.
raising money. That's important, right? And what you make as a co-manager or GP or co-sponsor, whatever you want to call it, what you make has to make sense for those substantial other duties. Meaning it can't fluctuate up or down based on whether or not or how much you raise.
Mm-hmm.
So it's got to be a set amount based on the other duties.
You're telling me that if I just met you off the street or I was meeting other people and they're like, oh, you have a fund. Well, I know my rich uncle and he's got $5 million. Can you pay me if he invests, say, $1 million with you? Can I get 10% or whatever? And the answer is, I appreciate you making an introduction. However, that would be against securities law for me to compensate you for bringing money because you don't have a securities license. However, as more research, and this is a little gray, but we were talking about it earlier, there is something considered calling a finder's fee, but it's a flat fee and it's not based on how much capital is coming in or if they do invest or don't invest. It's just, I'll pay you $500 for any introduction that you make, and whether they invest or not, and then whether they invest $1 million or $100,000, it doesn't change your 500. Is that okay, or is that still just don't even mess with anybody? They have to be accredited, and we appreciate the introduction. And I hope to, I don't know.
Yeah.
Can we buy them dinner?
It's tricky.
Like, what can we
tricky.
do? Because so many people know people that have money and they're trying to get involved.
Yeah, but here's the thing, though. Here's the thing. Raising capital, the bottom line is that to raise capital, you generally need a license. Just like you need a license to practice law, just like you need a license to practice medicine. If you're going to go raise money for other people, you need a broker-dealer license. That's what you need. Now, there's an exemption to that, which we just talked about, the issue exemptions, as long as you're doing substantial duties, as long as you're not getting paid transaction-based compensation, as long as the primary role is your substantial duties, you're good. Some people try and squeeze this little finder's fee, which is a very, very, you gotta get that
thread the
needle so tight. I don't think I've ever seen somebody who can do it right. If you wanted to pay somebody, the only way I would do it, to be honest, it would be safe, is I said, hey, look, Cody, I've got a list of 1,000 investors. They're all high net worth individuals. They're all looking for investors, man. I will give you this list. You pay me $50,000. I'm not involved in the transaction. I'm not calling these guys up and say, hey, this guy Cody's going to call you. He's awesome. He's got a good deal. I'd highly recommend you invest with him. I'm not involved at all. I'm literally making a referral, just like when you get paid. When sometimes you get paid from, I don't know, freaking Jack in the Box, and you make a referral and they give you like a $5 off or whatever. It doesn't matter whether they buy it or not. If they make the referral and the introduction, that's what you're getting paid for, then maybe. But I've yet to this day seen an introduction that doesn't violate the rules, because inevitably they're like, oh, you should talk to Cody, you should talk to Brian. They really know what they're doing. They got a great deal. Anytime you start introducing a comment.
Yeah, but let's say you did that and I wanted to pay you for it. I can't do that direct, but I just say, hey, get me the phone number of your cousin. I go to the cousin. I say, I'm going to loan you $2,000. And if you never pay me back, I understand. And I give it to the cousin, then the cousin loans you the money and you never pay the cousin back.
It's all just bad. Just
I'm just
all
saying,
of
I
it.
watched Suits. This was an episode of Suits, and this is how they got the money to the
Got
right
it.
person, and the attorneys didn't get in trouble. I'm just doing what they did on Suits over
has
here.
better
I was
writers.
going to say, not in our
They-
Clever
they-
Capital Fund.
they have better
Ain't going to
writers.
happen. But yeah, I love that. So going back to my original comment about why you want to leverage a sponsor's track record is because you'll have the opportunity to raise for their deals through a fund-to-fund creation,
Yeah.
not as a co-GP or anything like that. And then you can have your own accredited investor list that you're building so that when it's time for you to raise your own money for your own deals, you already have a accredited investor list that you own and that's yours.
Yeah.
So that's the cool part.
I love the fund to funds model, but you do have to be very careful with it, right?
Yeah.
It would be easy without proper guidance to trip over some non-compliance, because you're not only having to comply with securities laws, you also have to comply with advisory rules, because you really are advising investors on your fund.
the fund,
right?
yeah.
You're advising your fund and what to invest in because you're buying securities.
Let's just back it up so everybody, so we don't miss it. So
Sure.
in a fund of funds, and just using your specific example, what we do is let's just say me. Let's say Bethany and I, we want to partner with you, or we like what you're doing, so we want to raise some capital and put it into your deal.
Yep.
Bethany and I would create our own fund, go hire our own securities attorney. We would raise the capital legally. We do a private placement memorandum. We'd follow all the same rules you guys are following. We'll go raise $1 million or $2 million or whatever we're raising, and then we would then invest a portion of that into your deal. Right? Our fund would become a limited partner in your fund. That's why it's called a fund of funds. And to Bethany's point, in addition to worrying about your 506B or 506C, which we talked about, it opens up a whole new can of worms and other regulatory issues, because now what happens, check this out. You guys are investing in real estate. I'm investing in shares in your company. I'm investing in securities. That's why it's a completely new ballgame. If I was investing in real estate, I don't need a license to go buy real estate. Anybody can go buy real estate. But if you're now buying securities, you may need a license. Now we got to look at all that.
So let's just help somebody understand that, because if we're raising, let's say, a $50 million fund, and you're like, I love that you guys got these interest rates, and this I get to participate in the equity. Okay, we're gonna take our fund that has $2 million and we're gonna take $1 million and inject it into your fund.
Perfect.
Now you're getting the returns I would be giving, and are you
Yes.
passing those through to your people,
That's
or
a
it's
good
whatever
question.
your deal is?
So
with them?
my revenue, instead of being the revenue from operations or from rents, my revenue is the distribution that you're giving me. Right. So when you distribute whatever you're distributing to your investors,
So you
I'm just
might
one of
be
your
promising
investors.
your people 7%. We're promising you 10% or 12%
Correct.
or
Yeah.
14%, and you're keeping the spread.
Yeah, what'll probably happen is, like, let's say we invest $1 million and then you give me $100,000. That's my annual 10% return, right? So I get $100,000. I might split that 80-20 with my investors. I give my investors 80%, so 80 grand, and I keep 20% for doing all the work, for setting it up right, for getting to know you guys, for doing all the due diligence on you guys, for doing the due diligence on your fund, for putting in all the work and setting up the fund. Then obviously you're going to get compensated. And the typical compensation model, and I think it just comes from the hedge fund world, is that 2 and 20, which is I take a 2% at what's called an asset management fee. So it's 2% of the funds that I have under asset management is kind of my ongoing fee, and then I take 20% of the profits. So if you give me 100 grand, I'll take 20 grand. I'll give 80 grand to my investors, and that's how typically the master fund would get compensated. But you guys just treat me as a regular investor. I just happen to be a kind of an institutional guy because I'm a big fund.
So to clarify that, then that means that if I'm out raising money, Mauricio is raising money for your fund, you are not paying us to raise the money.
Correct.
You're giving us a return just like any other investor. Now, if we're smart, we're gonna negotiate with you and say, hey, dude, we're writing a real big check. I want a better return than your $50,000 investors.
Okay, so that's really interesting. So I can, if I put out a PPM in marketing that says, you give us money for 1 year, we give you this return. 3 years, we give you this return.
And what does
5
the
years, we
PPM
give-
stand for? The
Private
private placement
Placement Memorandum.
memorandum.
I don't think you need. We could probably just go grab lunch or something. I don't think you
They don't even need us.
I know, Brian, thanks, Brian, for checking me. And we put out all this marketing, and everybody starts piling in. But then you come in with a bigger check. I can cut any deal I want with you. It doesn't matter what I've already done with everybody else.
The better time to do it is before you start raising any money, because if you cut a better deal with us after you've raised money, you've got to go back and let your investors know. And if they want out, you're probably going to have to figure out a way to get them out because you've now put them behind
So
somebody.
what's a creative way for me to give you a better deal without having to go back to $25 million worth of other investors and
Yeah.
like make it right to them.
Take it out of your cut.
Yeah.
If it's out of your cut, it doesn't affect the investors, right? If you're giving the investors a 15%, 12%, 14% return, and you want to give a little bonus to me and Bethany because of our fund, but it's coming out of your pocket, your share, then that doesn't affect the investors. There's no material change for the investors. They're still getting the same stuff. So
I
that's
don't
one
have to
way to do it.
disclose that to anybody.
And we
You
can
don't
also
know it.
you
create,
can give away
we
your
can
own.
create classes in our PPM
That's
where
the better
we have
option.
thresholds
Yeah,
and
is to plan ahead.
benchmarks.
Get this guy.
At
Yeah.
$500,000 or more, you're going to get
Yeah,
this.
that's the best
Yeah.
option is to plan ahead
Unpack
for
that real
it.
quick.
Well,
Let
you're
let them clarify.
let me clarify.
You're not,
So-
you're not the damn attorney.
No.
Yeah, no,
Right.
but he's got
No,
it
it's
down.
good,
He's got
yeah.
it down. So
It's
go
good.
ahead.
So the
By the way,
best.
this is the first time we've been on a podcast together, so it's really
We're trying
challenging
not to
for us
step
to not
over
step
each
on each
other,
other. I just want to let you know that.
I love it.
You'll see that I'm sometimes just like, go ahead, take it out,
Not
take it away.
me. I'm like, anyway.
So I think the best thing to do is to plan ahead and plan ahead for large check writers, whether it's going to be a fund of funds or private equity or some really rich
Family
uncle,
office, something
whatever
like that.
it is. Yeah, to plan ahead and create a bigger class that says, if you invest more than 500,000 or you invest more than $1 million, we're going to give you this return. Everybody knows upfront that exists, right? So if it happens, it happens. If it doesn't, it doesn't. Right. So you're planning ahead for it. And then your other investors already know that there's a possibility of that happening. So you don't have to go back and apologize to anybody.
So I could say, hey, you put up 500 grand or more in this new clever capital fund. We're going to call this the Big Sexy Fund. We need a name. Not only am I going to give you this extra, bonus, a little whipped cream action on it, you also can come to my cool treehouse resort in Belize
Yeah.
that I happen to own.
There you go.
And you get to come, hang out
Yeah.
with a bunch of other cool people. We'll do some retreats and other stuff. So you can almost qualify for like perks.
Yeah, yeah, that's right. A lot of funds do that. A lot of straight up syndications will do that. They'll have sort of a special club. Brandon Turner does Cabana Club, right? We have Empire Club at ours. So you could
What's our
you could
club?
have some
We're the Banana Hammock Club.
the Banana Hammock Club. There you go.
What are we? What is
Love
we
it.
need?
Sexy. There's some
the big
sexy club. It's gotta
big
be the
sex-
big sex.
sexy beast. I
This
don't
is
know,
the fun
something.
part where you actually said, okay, every investor that does 250K or more, we're going to plan an annual retreat, and we're going to go over all your investment,
Mhm.
criterias and other things that you're working on. And it's our own little mastermind that you get free access to because of this.
Yeah.
So now you have a trip to.
I love this.
Okay, cool.
Send me a postcard from that retreat. Let me know how that shit
I'm
goes.
out. I do want to
You
clarify.
got to cut the
one
big boy
thing.
check. You want me to show up?
I do want to
$1 million.
clarify.
That's
Yeah.
right. I think $1 million.
You cut
It's
a $1
gotta
million
be $1 million,
check. I'm
yeah.
showing up. I'll
Yeah.
do anything you want.
Everybody
Literally,
already
I'll
sees
be,
you without the shirt on running in the morning.
I know.
I'll be in the Chuck E. Cheese
We don't need
outfit,
you on the
dancing
yacht with
around.
your
if you
shirt
need me to.
the panda
That's
hat.
fun.
And by the way, the other
That's
thing I know
hilarious.
but the other thing you can do too is like you guys are at a perfect spot to do this. We haven't finalized the fund yet, right? So we're not. We haven't gone to market. So if you've got a couple of other big investors right now, you can be negotiating with them today.
Yeah.
Yeah.
Say, hey, I know so-and-so, he's got $5-6 million he wants to do. Let's negotiate. What are the terms you want to do? So that way, when we finalize the documents, we already put all those terms into the documents. So
Correct.
that's something you guys can do now because we haven't actually finalized.
And actually, timeline-wise, since we've been working on this in the background, we started working on this. I was working on this with 4 months ago. So I mean, we have
like
weeks,
a pseudo pitch deck already created.
We are a couple of weeks away from wrapping this. Okay,
So let's throw it out on the table, Brian.
Sure.
All right, so everybody gets to watch the thought process. All right, Brian and I hire you. We cut you what? How much does a fund cost?
20 grand.
Okay, so it's gonna be 20 grand or less, somewhere
Or
in that
less,
range.
20 grand or
okay.
less, yeah.
Could it ever be more?
Yes, it could be.
Yeah. What would
you got a sweet deal. Let me just
You
tell
did.
you.
You did. Usually, if it's more than 25 million, the risk goes up, insurance goes up, all of that. We charge more. We're not doing that.
on your end?
And SPVs, you could probably get closer to like $6,000 in my experience. Just syndications for a single address versus like a debt fund and equity fund.
Not if you're going to do it right.
Yeah.
Okay.
There's probably some stuff stripped away that you actually need. Yeah.
Is that the
there's-
templated downloadable
Yeah.
internet
Right.
version?
Is that the-
Did you go to? Did you get
Is
caught
that
up in
the
a
AI?
fund
Is that-
guru's
Yeah.
No,
web
maybe that was because of
for free
No, some of
99?
Just so you
I'll
know
put your ass in
those
jail.
are out there. No. So let me just there are
I think it's
outfits out
because
there.
the original fund already created a lot of it, and it was just
Oh, you mean
kind of like,
the fund of funds?
yeah,
The fund of funds we do for $7,500.
Correct,
But we
yeah.
also we train them. We make them
Cool.
we make them do it our way.
Yeah, because that's
frankly,
the
to
big
make sure they
question
don't
is
step in it.
what's the entry fee to start raising money, and you can get started for as little as $7,500.
That's right.
Yeah.
It makes it sound like we should throw in a set of knives.
Yeah.
I used to sell world's finest cutlery Cutco, so
I did
know
too.
a guy.
So did I.
know a guy.
No way.
But if you do the 7,500 in the next 30 days, you get to go to Belize and hang out with Bethany at her retreat.
right.
Let's go.
That's right.
Yeah,
I do
Bethany
want-
owns a treehouse resort in Belize, by the way.
It's
That's where
rad.
this whole
That's where
concept
it's
came
from.
from.
I do want to clarify something
Yes.
before we move too far past, because we talked about if you don't already have a class or you want to give a kicker of your GP interest or your, something of yours, right? You don't have to disclose it to your investors, but to clarify, you can't pay it to Mauricio and me. Because it looks like you're paying us to raise money. You'd have to pay it to our whole fund, and then we'd have to share it with our investors as any other income. Just want to clarify.
Got it. Yeah, that makes sense. All right, so let's say we're going to throw out on the table. Brian and I show up. We give you 20 G's. We're like, all right, we want to set up this fund. It's going to be a $50 million fund, not a $150 billion fund. Maybe I don't know. Were you serious about the 100 million?
Oh yeah.
What the fuck? We're just like, you just like switch it up on me. I thought we were doing a $50
You
million
want to go for
fund.
200?
No.
Yeah,
Keep
I know.
talking.
Why not?
Well, I want to talk about the depreciation
Yeah.
of something. That's news
Okay.
to me as well, but go ahead.
So we
Yeah.
want to do a $100 million fund. He's just going to make me work forever to raise all this capital. We want to do a $100 million fund. And you're like, okay, what happens now? We say we're going to do a fund where we were going to do some commercial, some residential.
So
Okay.
step one is we send out, first of all, we send out a questionnaire so we can get some basic information, what you're trying to figure, get an idea of what you guys are going to do. And then we get this pitch deck. You guys have been working on this pitch deck a while. And so typically they'll send us whatever pitch deck you have, right? And sometimes it's beautiful and perfect because they've been doing it for a while. Sometimes it's a freaking 2-page Word document that has nothing in it. But we want to review that because we want to get an understanding of what you think anyway you want to do it. And then we hop on a call. We call like a strategy call. We dive into both the questionnaire and your business plan. And that's really when we start working with structure. Like, we had the conversation like, well, I'm thinking about doing it this way. I want to have 3 different classes. The more time you're in, the more money you invest, you get better returns. And so we start molding the fund during those calls. And with the fund, it generally will take more than one call. It's usually, 1 or 2 or 3 calls because there's just a lot of moving pieces,
Usually
right?
by the business plan, that's like call 3.
And what I noticed is it's not like black and white. It's not like you have to raise money this way. You have to pay this type of return. You can actually curate your entire fund the way that you want it and just disclose it properly in the PPM. And basically, it's like you can have your cake and eat it too.
Here's the beautiful thing about syndications that you can structure it and do whatever you want. There's very little things you cannot do, like paying capital raise and doing that. Very few things you can do. The only thing you got to make sure is that you disclose. If the investors are going into your fund and they have full disclosure, they're going over with their eyes wide open, then you guys can structure the fund however you want. We just want to make sure the disclosure.
And he can sell it.
Yeah. Well, okay. So that was my
That's an
thing as
attractive
a
enough,
marketer. I was
don't
like,
even think we're going to sell it. I think it's really offering this opportunity, to be honest with you.
No, you're right about that.
A lot of people are W-2 or entrepreneurs, and they are just like chomping at the bit, the opportunity to learn real estate from somebody with 20 years experience, break down deals, share in some depreciation potentially, and also have a fixed double-digit interest return. They can't even sometimes get double-digit interest returns in their own business. Some of these businesses, EBITDA is 7%, 8% on $3 million, $4 million, service businesses. So the fact that we can multiply their money for them is more of an opportunity. So I think Cody's job is easy. Let's see what happens.
yeah. Well, okay. So we come in, we want to do a $50 million fund. Our concept of our fund in our little pitch deck that we send over to you through this discovery is we want to pay investors 10, 12, 15, 14?
10, 12, or 14.
10, 12, or 14%.
1, 3, or 5 year commitment.
Depending on how long they lend us their money for. Right?
Yep.
So you're going to look at that and you're going to, and I want to be able to generally solicit.
Yep. So the first thing we'll figure out is the exemption, right? Because we start with that. So, what we're not going to register, we're not going to do anything illegal. So what exemption are we going to rely on? And so we ask a bunch of questions. For you guys, it's very clear because you guys wanted to advertise. You wanted to go blast it and go to the top of the mountain and scream and say, hey, we've got a fund, we've got a webinar. You want to advertise. And so at that point, your exemptions shrink really, really fast. So there's really only 2 options. And so we went with the 506C option, which allows you to do that. So once we figure that out, then our whole job as securities attorneys, once we understand your deal, is to pepper you with questions so we can figure out what all the risks are of your particular investment. And every investment is unique and everybody has different risks, but the way you structure it, what are the risks of doing that? What are you investing in? What are the risks in that? What loan products are you getting? What's the risk in that? What markets are you investing in? So our job is to just pull that from you so we can put it into this disclosure document called the Private Placement Memorandum, the PPM, which, by the way, is a funny story. I always like to equate, for those of you who don't know or haven't seen a PPM, it's the same as a medical consent form, right? When you go have surgery, like I have terrible teeth, so I get oral surgery all the time. And so I go to the oral surgery, I don't know, wisdom teeth taken out or whatever. And before they put you under, they always give you that like yellow sheet, right? The medical sheet. And it just says, here are all the ways that my surgery can go wrong. I can have some bleeding. I can get an infection. I could die from getting my wisdom teeth out right. So you just look at all those risks. You sign it. The doctor comes in, signs it again, and boom, you're off to the surgery. It's the same thing. We're creating this disclosure document so the investors can go in with eyes wide open and just understand the risks are. And if they're comfortable with the risk, that's their call. If they're comfortable with the risk, if you guys have done a good job of educating about what the fund's about and how you've been mitigating the risk, which you guys have done a really good job of mitigating the risk, then they can make a decision. They're adults. They can say, good, I like it. I want this. I want to invest this much. And they sign that disclosure document to say, hey, I'm aware of the risks. I know it's not guaranteed. I know there's always risk in any investment. And then you move forward.
Got it. So let's say they say, I'm committing my money for 5 years and we're giving them the highest return we can. We're 2 years in. They have some medical issues. They call Brian up, say, Brian, sorry, bro, I need my money back. You have to give it back.
What's the game plan?
But we would work to.
Well, first of all, no. So hold on a sec.
Yeah.
If you want to work something into the docs that gives some scenario, like if that were to happen, hey, if you guys have some kind of a medical emergency and you can show me about, we're happy to give you your money back, and this is how much we're going to give you. We're just going to give you your.
But here are the conditions.
But here are the conditions. So as long as you disclose that, now that's not generally how it works, right? How it generally works is you're putting the money in and you committed to 2 years or 4 year, whatever the number is. So it's an illiquid. That's one of the disclosures. It's an illiquid investment. It's not the stock market that you can liquidate tomorrow. Real estate in general is an illiquid investment. So you're expected to stick around till the end. Now, are you going to work with them? Generally, good operators will tend to work, but you're under no obligation to do that. But again, if somebody's got some medical emergencies.
The reason I was asking is, let's say that scenario happened and they're just throwing a conniption fit, but we don't want to give them their money back for whatever reason.
Obligation.
Is there any, there's no legal obligation.
There's no legal obligation. There's a contractual arrangement with your investors and there's no agreement. In fact, we've told them, hey, you are not going to be able to get your money back.
So at that point, if they sued the fund,
nothing.
They're not going to have much.
Now, at that point, you better hope you had good lawyers to make sure that there's nothing to peel back, though, to nab you on.
Yeah.
Right? Because this is like the redemption option example we talked about earlier. Where you're like, well, I'm not really sure. That would be an example of a reason why you might give a redemption option, which is really just an investor's option to get out and rules around it.
Yeah. I mean, it's the same thing when I get a mortgage on a house or a property and they have something that's called a prepayment penalty, right? They're going to charge me a 5, 4, 3, 2, 1 step down. And if I have $1 million mortgage on a property and I want to sell it within 6 months, I just now have to pay $50,000 penalty.
Right.
Well, if I only invested $100,000 and I got a $50,000 penalty,
but you
you'll
don't
give
even
me
have
your
to,
money
you don't
back,
even have
but
to
you're
give that
basically
option
losing,
if you don't want to.
an
Now,
opportunity. But now that's only if we choose to enforce that type of penalty,
but you've
or
got to
put
be
that
careful, though. You've got to be careful because you don't want to start treating investors differently. So it's better to plan for it ahead of time.
Yeah.
Now, one thing we do bake in to the docs as sort of a default is if an investor can go find a third party offer on their units, right? And the third party says, well, I'll buy them for you. Maybe there's a discount. Maybe it's just for the whatever they put in. Maybe it's something else. I don't know
if
what.
they transfer there to another accredited investor for the same amount of funds, then maybe there's no penalty. Sure.
But they've got to bring it to you first. And you've got to write a first refusal to go, we're going to do it instead of you selling it. Or we're just going to say no.
Yeah.
Right. So it at least provides
that's interesting.
a path.
So it gives them an out if they want to swap places with another accredited investor.
Yeah, it's great to think about. What is a subscription agreement compared to the PPM? Why is there two things? And when is a PPM needed and mandatory versus just recommended to protect somebody that creates a fund?
All right, I'll start with the subscription and you want to talk about the PPM?
Sure.
So a subscription agreement is different than the PPM. The PPM is just that risk disclosure, that disclosure, consent form, whatever. That's like what Mauricio was just talking about. That's all disclosures. The subscription agreement is really the contract where the investor agrees to give you the money and how much they agree to give you. Right. So that's where they're going to sign.
That outlines the shares or the units.
Yeah. I mean, there's still an operating agreement to sign, which is how they get their ownership. But the subscription agreement is the contract that says, I'm investing. This is how much I'm investing.
they're going to probably get 5 documents, right?
Yeah.
They're going to get
Okay.
a private placement memorandum, number one.
Mhm.
Number 2, they're going to get an operating agreement because they're going to be a member of your fund, meaning they're going to be a member of your LLC,
If it's
limited
an equity
liability.
fund,
If it's
yeah.
an equity. Number 3, you're going to have a subscription agreement. Number 4, you're going to have an investor questionnaire, right? That tells you, hey, I'm accredited, I'm not accredited, and you were verified. And number 5, you're going to have your business plan, usually attached as the last exhibit. That's what I call the offering documents, those 5 documents.
Correct.
Got it. All right. So now let's say I get my fund up. I'm raising money. I get out of my 100 million, I get 40 million.
Doesn't matter. There's no
okay.
obligation. If you
I'm-
raise
I'm-
200 grand, you're like, yeah, that's good enough. I'm going to put the 200 grand somewhere.
I can raise up to a certain amount, but at any point, now is there a time limit on how long I can raise this money?
Again, what is a doc? What do you guys want to do?
So that's the cool thing we were talking about.
some
Open
people do
end,
that.
Close end,
No,
evergreen.
Yeah, but some people, we've done clients that say, look, I'm going to take your money, so I'm going to have the money in my bank account, and if I don't find anything within X time, like 6 months, if I'm looking for deals and I can't find anything after 6 months, I'm going to give you your money back.
Because we're paying interest
Usually you should say-
regardless
yeah,
if
you
we
should
have an
usually
investment
say
or not.
no.
But again,
In
you don't
fact.
have to, right? I think you guys are doing a nice. That's the way you've decided. But some funds are like, hey, you're not going to get paid until we actually allocate that money. Now that's not as good of a deal for the investors. You
Yeah,
guys are doing
that-
well by the investors. But again, the beauty of these syndications, you can structure them any way you want, as long as we're disclosing it, as long as everything is in that disclosure document.
There's a lot of people take soft commitments and then they, go find the deal based off the
I
soft
don't
commitments.
love that word.
And I've never
I prefer the
utilized
term
that.
deposit because
Yeah.
the soft
Yeah.
commitments just imply that you just like, oh, I'm in for 100 grand, take me down. What we like to do is like, no. If you're in for 100 grand, sign all the docs, so it's a legally binding thing. But instead of wiring us 100 grand, just wire us 10%, wire us 10K. And when we need the other money, we'll do a cash call. We'll say, hey, we just found a deal, we got in a contract, we need the other 90.
Ooh.
And if for whatever reason you don't come up with the other 90, then you forfeit the 10%.
So I have a question.
Oh, I like that.
Yeah, there's
Brian.
got to be
There you
teeth
go.
to it.
All right,
Otherwise, you're
I like
always
where we're
raising.
moving there.
I have a question.
I think for the 1 year,
Sure.
I think we do that.
Okay, we can write it in the PPM.
Yeah,
Let's do it.
maybe the 1 year and the 3 year.
This is the difference between the $5,000 syndication and the $25,000
The strategy.
syndication. You get these strategies from people who have been doing it 50 years together.
Yes, and that's why we have, utilized different securities attorneys, and not that any of them have been, bad or not good or anything like that.
But you found the
we-
right ones at
We
the
have
end.
found
Yeah,
the
you
best.
landed in the right
And
spot.
we
You
are
found the right
Premier Law Group is
Well-
the best. So, question: can you do more than one fund at one time? Can I have a 506B, a 506C? Can I have a fund to fund? Can I have a Reg CF? Can I have all 4
He's asking
funds?
Can you
all the
raise
questions.
$350 million, Cody? Is that what he's asking?
I'm just saying, can I do a syndication for a big 500 unit apartment complex separately, and then
In theory,
an equity
if
fund
it's
over here?
Clear
that's
that it's
just
different. You want to be very careful about the
Yes.
advertising rules if you're going to take non-accredited investors. So the thing about 506B is the rule is simply that you can't generally solicit or advertise. You need to be able to demonstrate that investors didn't come in as a result of any advertising or general solicitations. You've got to be very careful.
and that's why I only wanted to do.
so how
one
did
at a- one
like
one
Uncle G,
fund.
Grant Cardone do that?
Yeah.
Because he's so out there, so like everything's marketing all the time. How
So
was
if
he
you
able
watch,
to raise money
so
for-
Uncle G's great, right? So what he did is when he started, if you go back to his social media like 5 or 10, maybe 15 years ago, he started with 506C. And his minimum investment was $250, $500. I mean, these were like for high net worth individual because he wanted to advertise. But as his profile got bigger and bigger, he wanted to take all of these non-accredited. He wanted to take $1,000, $1,500. So he went with another exemption. Remember, the rules are the same. Register, find an exemption, or it's illegal. So his exemption is one's called Regulation A. Instead of D, it's Regulation A. And that allows him to advertise. You're going to love this one, Cody. It allows you to advertise and take non-accredited. And so Cody's like,
He's
wait a
like,
minute.
well, wait, why
a
are we
minute.
not doing that?
And you can
There's
take
a catch.
minimums of 1,500, 2,500.
Well, there's actually some limitations.
there are some
If you're non-accredited,
No.
you can actually only invest a certain amount.
Yeah,
You're
but
limited.
you
to the
can
amount of
only raise up to, I think, is it
75 million. So you'd have to be
Reg A.
limited
Oh, is
to
it
75
million?
But here's a catch,
There's
Cody.
two
'Cause I know
different-
I can see Cody's wheels going a little bit. So the difference is
It's a-
you have to actually register that. It's kind of a mini registration with the SEC. So you prepare the documents, then you have to submit those to the SEC, and then you spend the next 6 to 9 months going back and forth with the SEC and the attorneys at the SEC, because they're going to say, well, I don't like this, I don't like that, your website, so you got to change this, what's that? So you literally go back and forth with the securities attorneys at the SEC, and it usually takes about 6 to 9. I think Grant, from what I understand, because I know the attorney who helped him the first time, because he was a public figure, they gave him a little bit of a harder time. So I think it took a little bit more than the 9 months. But there's the registration part, which number one means the cost is not 20 grand. It usually
It's like $100,000,
it's
right?
closer to
Closer,
100
yeah.
grand. And then there's ongoing compliance. It's not the same as when you're public, but instead, when you're public, you've got these quarterly reports, these 10Qs or whatever, but you still have entry reports, exit reports, quarterly reports, audited financials, and there's like ongoing compliance
It's a
costs.
whole infrastructure.
Yeah,
that you have
with
to
more
build.
So
work.
it's a mass. So that's
Yeah.
why most people don't do it. But theory, that's what Uncle G does. He does mostly Reg A's.
And we glossed over a really good question though that you had, which is when is it required to have a PPM, and when can you get away with not having a PPM?
Well, it depends on the exemption, but in general, what I would say is you're only required under the law to do a PPM when you have non-accredited investors. So theoretically, you could, under the rules, not have a PPM for accrediteds only. But we the only times we even do that is if you're raising money from like 2 or 3 investors that you've known for 30 years, 40 years, and it's kind of a small deal. And you're like, hey, I really know these guys really well. Other than that, you know, investors typically want to see PPM because the PPM protects the investors, but also protects you guys, right? Because it's like, hey, if somebody says, wait a minute, I didn't know that you were going to do this and that, and this was a risk. Oh, look at that, page 75, you know, there it is on section C. And then other exemptions may not require a PPM, but those are exemptions that we would never use, like a Rule 504, for example. Just throw that out there. But they're just exemptions that are so complicated that nobody ever uses.
So I have another question. How do you raise money, right? I mean, is there family offices? Is there...
Talk to Cody.
Yeah,
is
I need to
there-
know how to
Yeah,
raise
yeah.
$100 million.
You talk to Cody.
dollars.
No,
Talk
I'm
to
breaking it
Cody.
down for people. There's
gotta have that
I
registered-
have
smile.
4 podcast listeners that right now, like, I'll throw in. Everybody else is like, yeah, good luck with the $100 million.
There's register investment advisors, RIAs.
There are
right?
RIAs.
Which I
There's a
learned
lot of
Although
RIAs.
that's
recently.
tough. RIAs are tough. I'll tell you. And people always like, oh, I'll just get a broker dealer or I'll get an RIA. The problem with that was RIAs a lot of times have rules with their license about it's called selling away.
Mhm.
So a lot of them hang their license with a broker that says, well, we sell products. So you can't be selling something that's not our products
Yep.
to our client base.
There's allowing in your PPM and allowing a you said a class where you have the ability for other people to do fund to funds into your fund.
Yeah.
So now you can duplicate
Got that,
you
yeah.
times 1,000 people doing the same thing and
We call those feeder funds,
Yeah.
basically. You can
Yeah.
have other
correct.
funds
So
that feed into
that's
yours.
one way.
Yeah.
Doctors, dentists, you know, IRA, you know,
High net worth W-2s,
you know,
yeah.
reaching out to those types of people. You know, so just throwing out ideas of where we find people that are accredited and how to build an accredited.
Cody, you taking notes,
investor
Cody?
list.
Cody, you taking
Brian.
notes?
I really
Taking notes?
appreciate the education.
looking out for you.
What software did we use, like behind the scenes, to manage all of the people that piled
So
into our last fund?
we've used a bunch of different ones. We use InvestNext. We've used AppFolio. We're using Go High Level as our CRM to create the funnels and the automations sequences. And then there's a team. Let's talk about the team. So we're going to
That's the
have
important part.
investor relations. We're going to have compliance. We're going to have, you know, let's talk about what does it need. You know, who's your power partners? Who's your team when it comes to, you know, building out $100 million equity fund?
Obviously,
Who do
I'm
you
biased,
who do
but
you
your
recommend?
lawyers are really the
Correct.
most important
Yep.
part of your team, just while you're getting started, at least, right?
Mhm.
And I'll just, I'm going to toot our horn a little here, which is the $6,000 people that you talked about before.
Yes.
The PPM is a fraction of what it is that we do, right? That we talk about the strategy and all of that. We're also going to guide you on all the things you're going to say while you're out shouting it from the rooftops and selling these securities, because everything you say to a potential investor becomes part of your offering. So it better match what we've been disclosing. It better match what your pitch deck and business plan say.
And your website.
And your website,
Right?
all of it. And
All
we
the
review all
disclaimers,
of that.
everything on your website.
We make sure that you are compliant, not during just the sale of the security, but in the offer of the security. Because
So
the
a good,
SEC
a good
cares about
framework,
both.
yeah, a great framework. I always give this example. It's like when you do a presentation, whether it's a webinar or in live or whatever, just think of taking the transcript of that webinar and then attaching it to your offering docs. That's kind of what you're doing. So it's part of your offer.
What are the no-nos, right? You don't say the word guarantee, right? That's a big no-no, right? What are some of the other no-nos when utilizing a fund?
One of the biggest pitfalls I see, because we do a lot of deals with a lot of influencers, right? People with really big audiences, they're out there all the time. The thing I see that's the hardest is making sure that whatever you say isn't misleading without further context. It's really hard to throw a disclaimer at the end of a really short Instagram clip, right? So making sure that, hey, Cody said that it was going to be, hey, are you guys interested in getting 45% returns? Ooh, sounds kind of like you're offering that. We need some more context to make that not illegal, right? So whatever it is you're saying, it's got to be clear or have that extra context to clarify. That's the biggest mistake I see.
And just not that I'm a marketer or anything, but usually a good marketing, this is for you, Cody, if you want to take some notes. A good strategy is actually on the social media side is actually to promote the webinar, obviously, instead of, because a lot of people are like, oh, I've got this deal, and they give all the details. It's a 100-unit apartment building. It's a 12% return. They give all the details, which is always a little bit scary because that you get into these, like to her point, the anti-fraud provisions, because you're not allowed, you're supposed to disclose all the material facts, but you're supposed to not omit or leave out material facts that would make your statement sort of inaccurate or misleading. So if you just say, you're getting a 12% return, okay, fine, but you left out all the risks and all the stuff out here because you didn't have room. So usually you want to be a little bit more broad and, hey, we got a deal, it's an equity deal, it's between 10 and 15%. We're doing a webinar tonight. Here's a link, go register. And then on that landing page, you can put a lot more disclaimers than you can on a social media post.
Look, we're here. Actually, the reason we're here is because you are the GOAT, right, of marketing. If you just remember, in this instance, your lane, which is top of funnel. You're top of funnel. You're driving traffic to whatever the next level of funnel is so that you can get to that webinar and still do that, right? Still do that. You're not selling somebody $100,000 securities from an Instagram post. You're just not, right? So why get yourself in trouble and why risk it if it's not going to yield what you want anyway? So you're top of funnel. Just treat it like that.
Yeah, that makes sense.
Yeah, a lot of people, it's funny. Everyone's like, oh, I'm going to do a 506C. I'm going to advertise this thing on social media. And then they're like, oh, that didn't work. It's like, yeah, it's not that easy. It's not that easy,
There's a
right, Cody?
process, right? They should all hire you to do the process.
Yeah, I have no doubt we'll raise tons of money. But, I was prepared to fill up the $50 million fund. Now I just got to like shift my belief system a little bit. This is how that shit works, right? It's like, oh, okay, we're going for it. I just love what we're doing in commercial real estate so much. I'm so excited. These deals are phenomenal. They're big. I'm having fun again. I'm not fucking around with these little shitty deals, like we're doing the big boy stuff. Yep. And it's like fully reignited like my passion for real estate over the last couple of years. So I've had a lot of fun with that. And I think now is the time. Commercial real estate is just so prime right now with the way the market is. So I don't know. We covered a lot of good stuff with the funds. Hopefully you guys learned something from it. How would they get a hold of you if they wanted to check you out on social media? Yours? Yeah,
Bethany _LaFlam, LAFLAM.
You can do. I got a YouTube channel. I got pretty much every single topic on there. So Mauricio Raul on the YouTube channel or on Instagram. I just found out about Instagram like a month ago. At Mauricio Raul on Instagram.
It's been under a rock.
I have.
And your guys' law firm website?
PremierLawGroup.net. So PremierLawGroup.net. N-E-T.
Yeah, and if they go there and they say, "Hey, I heard you on the Clever Investor Show," make sure you take good care of them.
Absolutely.
And don't be scared to start your first fund. Maybe it doesn't have to be $100 million. Maybe it could be, "Hey, I want to go out there and raise $1 million. I want to go out there and and out of the $1 million, you actually raise $600K and you get your business started." So. I don't know. Anything else, Brian? clevercapitalfund.com
and email invest@clevercapitalfund.com if you want to set up a discovery session or anything else. We appreciate
Yeah, guess who you're going to be talking to? You're not going to be talking to me. You're going to be talking to Brian. Brian, I just wanted you to know Brian has actually done a phenomenal job learning all the nuts and bolts and everything that has to do with the admin side of the fund. I'm just going to be the marketing guy on the front end and then the real estate dude on the back end out there doing the actual deals. But what was it again?
Invest@clevercapitalfund.com.
Go. All right. Hopefully you got some value from this one. We appreciate you for hanging out with us. Go check out their social media accounts and tell them that you heard of them from the Clever Investor Show. Until next time, we're out of here. Take care. Come here. Peace.